Are you still parking your hard-earned money in the bank, thinking it is safe? What if I told you that every single day you are actually losing money without even realizing it? Yes, inflation, low interest rates, and sneaky bank fees are quietly draining your savings. This silent robbery happens right under your nose, and the longer you wait, the worse it gets. This is not fear-mongering, it is financial reality. Watch closely, because by the end of this, you might think twice before trusting the bank with your money again. Why bank savings lose value? Many people think keeping money in the bank is safe and smart, but the truth is, saving money in the bank might be hurting your wealth. This happens because of something called inflation. Inflation means prices of things go up over time. So, the money you save today will buy less in the future. Banks usually give very low interest rates on savings accounts. Sometimes, the interest you earn is even less than the inflation rate. This means while your money grows a little in the bank, its buying power actually goes down. You might see your savings balance increase slowly, but what really matters is how much you can buy with that money later. Also, banks can charge fees that reduce your savings. Monthly fees, ATM fees, and minimum balance charges all take away from your total money. So, saving in the bank is not really safe from losing value. If you want to keep your money's power strong, just saving it in the bank is not enough. You need to understand inflation and look for smarter ways to grow your money. Because if your savings can't beat inflation, you are actually losing money every day. So before you trust your money with the bank, learn why bank savings lose value. Inflation eats your money. Inflation is one of the biggest reasons why saving money in the bank might not be the best idea. Simply put, inflation means that prices of goods and services rise over time. When inflation is high, the value of money decreases because you need more money to buy the same things you used to buy for less. For example, if inflation is 5% per year, something that costs $100 today will cost $105 next year. But if your bank is giving you only 2% interest on your savings, your money is not growing enough to keep up with rising prices. This means even though your savings increase in number, their actual buying power is shrinking. People often think their money is safe just because it's in the bank, but inflation silently reduces the real value of those savings. Over time, this can lead to losing a significant amount of purchasing power. Understanding inflation is crucial because it affects how you should save and invest your money. Simply putting money in a bank savings account may keep it safe from theft, but it does not protect you from inflation. To grow your wealth and protect your money's value, you must find ways to earn returns higher than inflation. Before you keep money sitting in your bank account, remember this: inflation is eating your money every day, and you need a smarter plan to fight it. Low interest rates explained. Banks offer interest on your savings to reward you for keeping money with them. But these interest rates are usually very low, often below 2% annually. This means if you save 100,000 rupees, you might earn just 2,000 rupees in a whole year. While this sounds like free money, it's actually not enough to keep up with inflation or help your wealth grow. Central banks set low interest rates to encourage people to spend and invest money instead of just saving it. But for savers, this means your money grows very slowly in the bank. Meanwhile, the prices of everyday things like food, fuel, and housing keep rising faster than the interest you earn. So, even though your account balance increases slightly, the real value of your money is falling. Another problem is that many savings accounts have tiered interest rates. If your balance is low, the interest rate might be higher, but for larger amounts, the bank pays even less interest. This discourages saving big amounts in one place. Low interest rates mean that saving money in the bank is safer but not profitable. To protect your money's value and grow your wealth, you need to look for other options that offer better returns. So before trusting your bank's interest, understand why low rates hurt your savings growth. Hidden bank fees to know. Many people don't realize that banks charge fees that reduce your savings over time. These hidden fees include monthly maintenance charges, ATM withdrawal fees, and charges for not maintaining a minimum balance. Even small fees can add up and slowly eat into your money. For example, if your bank charges a monthly fee of 200 rupees, that's 400 rupees a year gone from your account. If your interest earnings are low, these fees can completely wipe out the profit you make from saving. Sometimes, banks also charge fees for transferring money or for using services you may not need. Because of these hidden costs, your savings in the bank may not grow as much as you expect. This is another reason why just keeping money in a bank account may not be the smartest choice. Always check the fee structure of your bank account and consider how these charges affect your overall savings. Knowing about hidden fees helps you avoid losing money silently. It might be better to look for accounts with low or no fees, or explore other saving options to keep more of your money safe and growing. Better places to invest. Keeping all your money in the bank is not the best way to grow wealth. There are better investment options that can give higher returns than a savings account. Stocks, mutual funds, real estate, and gold are some popular choices. Stocks can provide good growth over time, but they come with risks. Mutual funds pool money from many investors to buy stocks or bonds, spreading risk and making investing easier. Real estate often increases in value and can generate rental income. Gold is a safe asset that holds value during economic uncertainty. The key is to diversify. Don't put all your money in one place. Investing wisely can help your money grow faster than inflation and build real wealth. Before you invest, learn about each option and choose what fits your goals and risk tolerance. So, instead of just saving money in the bank, consider smarter investment choices that help your money work for you. Emergency fund vs. savings. Not all savings are created equal. An emergency fund is your safety net. It covers unexpected hits like medical bills, car repairs, or job loss. This money belongs in a safe, easy-to-access place, like a savings account or liquid fund. But your long-term savings, that is for goals like buying a house, funding education, or retiring, this money should be working for you in investments, not sitting idle. Keeping emergency cash in the bank makes sense. Keeping all your money there does not. Balance your approach. Protect some, grow the rest. That is how you build both security and wealth. How to grow your wealth. If you want your money to grow, simply saving in the bank is not enough. To beat inflation and increase your wealth, you need to invest wisely. Investing means putting your money into assets like stocks, real estate, or mutual funds that have the potential to earn higher returns. Start by setting clear financial goals. Know how much money you need and by when. Then choose investments that match your risk tolerance and time frame. For example, stocks and equity funds can offer high returns but come with risk, while bonds and fixed deposits are safer but offer lower returns. Diversify your investments to reduce risk. Don't put all your money in one place. Spread it across different assets. Also, keep learning about money and investments to make better decisions. Keep learning. The more you understand, the smarter your decisions will be. Wealth does not come overnight, but with regular saving, smart investing, and time, your money can grow beyond inflation and build the future you dream of. Ready to stop losing money? It starts today. If you are tired of watching your money shrink in the bank, it is time to make a move. Subscribe now for real tips that protect and grow your wealth. And tell us, what is your biggest challenge when it comes to saving or investing? Drop it in the comments. And do not miss our next video, the $5 rule that can make you rich in 3 years. You will not believe how simple it is. See you there.